I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. Got a bunch of positions on right now. A couple of them are a couple of the longs are really shorts because they're inverse ETFs, the TZA and SPXU, which I've been trading really actively, particularly that TZA, for probably over a month now. Got a couple day trades on today, got some swing trades on. So real quick about me, I am senior trader and registered principal at T3 Trading Group. I run our Manhattan office, the trading floor there, which is our headquarter office downtown at One State Street Plaza, when it's able to be open, when we're not in the middle of a global pandemic. I was definitely a little bit worried when we shut down the office just because we had to get everybody out of our offices and get everybody remote, but it turned out to really not be a problem for the most part. Probably guessing 60+% of our traders are remote traders to begin with, so we already had all the infrastructure in place. Trade support team was ready to go. Everyone was able to log into the VTF remotely for the morning meeting, the afternoon meeting, so all good there. And I have worked with over 100 professional traders with the firm, currently managing a group of over 50. In my part-time passion is martial arts. I've been involved in martial arts. Actually, 2 days from now is my 30th anniversary in martial arts. I just looked that up this past weekend. July 16th, 1990 is when I first got involved in the martial arts. So I've been doing that for 30 years, been teaching for like 15 years. I won 2 world titles in kickboxing in 2 different weight classes before I retired from that sport. Definitely missed the competition. So that's a little bit about me. If you want to get in touch with me, you can reach out at any point. This is my email address right here. If you want to get in touch with me on anything related to T3 Trading Group, trading prop with us, opening up a retail account with us, feel free to reach out and I can provide more information. I'm going to talk about that a little bit later in today's webinar. All right, let's go to the charts. So all I want to do is talk about the market. Okay, so we're going to start with a chart of the S&P. So yesterday was a really important day. So here's a daily chart of the S&P. Basically just has my 8 and 21 EMA, which are a couple moving averages that are really important to me. I utilize them as representative of technical equilibrium for any chart that I'm looking at. And there's also a 200 simple in here. Last week, we were talking about, so leading into last week, we had this really strong rally from the low, from support down here. So the market has been range bound in the S&P. The NASDAQ has not been range-bound. We can talk about that in a second. But the S&P 500 has been very range-bound. And range-bound price action can be a little bit difficult for people from time to time. A lot of the times in a range, when the market's looking worst, that's when it's actually time to buy because you're near support, even though things look like they might be about to break down. And then a lot of times when things are looking best, that's actually when the market's about to go in the other direction. That's like inherent in range-bound price action. So a lot of the times when a range is going to break, you start by seeing either a higher low in that range or a lower high in that range, depending upon the break. So if we were to go all the way back to this day, when we last tested support of the range, which is, June 29th? So on June 29th, we were at this low. We bounced off that low, and what we wanted to see on the way up was if the SPYs would make a lower high somewhere in the midpoint of the range, maybe around 310 or so, that would then set us up for a retest of support again, and then a potential break. Not what happened. Market rallied all the way back up to the top of the range in 1 week. So this was a very strong week for the market, got all the way back to highs. And then coming into this next week here, which I guess is last week now, we talked about, well, market just had a huge run here, 5 days from the low of the range to the top of the range. Like literally on the 29th here, we were breaking below 300. And then on the 6th, which was about 5 trading sessions later, we were testing the 318 upper band of resistance we've been talking about. So where do I get 318 from? 318 is really this gap fill right here. So understanding how gaps work in the market, a gap fill will oftentimes act as resistance. So that's really the area that I've been looking at as resistance, is up near that 318. And we talked, all right, it got up there too fast. Market needs a rest. And the most bullish thing I thought that could possibly happen would be if the market rested and then made it a little bit of a higher low, the opposite of what I was just describing for a potential breakdown, a higher low somewhere between 312 and 310. That's what I was telling my team in the morning meeting. Well, what happened? Rest day, pull in on this day. Low is 310.68, right into the sweet spot, right to where the 21 EMA is. Close strong, so a little bit of a tail there. Next day, we close right at resistance, and that's Friday. And then Monday, yesterday, we gap up to 320. So we gap up above resistance. When you gap up above resistance, it's a special type of gap. It's called a breakaway gap, a potential breakaway gap. Breakaway gaps tend to not get filled. So, one of the things that I do every day as part of my morning research is I'm analyzing gaps. What type of gap is it? And the most important thing when you are analyzing a gap is specifically trying to figure out how is this gap positioning the people who are already in the marketplace? Because if you understand how people are already positioned, then you have a good understanding of what they are most likely going to do in the future based on how price action changed. So a lot of times we're dealing with what's called a common gap, and common gaps tend to get filled. Like today's small gap down in the S&P was a common gap down. But this gap yesterday morning was a breakaway gap, meaning we gapped above resistance. And breakaway gaps tend to not lead to gap fills. They tend to lead to the opposite. They tend to lead to gap and go type scenarios. So for myself, I have been primarily working the market to the short side over the course of the last month and a half, I would say. And the main way that I've been doing that is through the TZA ETF, which is the small cap bear. So it's very correlated to the IWM. So here's TZA, right? So it's a 3x bear ETF, and here is the IWM, which is the Russell 2000. So real quick, if you look at different markets, right? So the three main indices, the Dow is not one of them. The three main indices are the NASDAQ, the S&P 500, and the Russell 2000. That's what real professional traders are looking at. The Dow is just not representative of the market because it's not enough companies, right? It's only 30 companies, I think, that are actually in the Dow. So really what we're looking at is the NASDAQ, it's primarily tech, the S&P, which is a bit more balanced, but has a lot of larger caps in there, and the IWM, which is the ETF that represents the Russell 2000. I think that the IWM, out of those three indices, is most representative of the true economy right now. Because we all know the story. We know why NASDAQ has been so strong, right? These companies like Amazon, they're able to take advantage of the coronavirus. So, no one's going to Macy's right now. No one's going to JCPenney. No one's going to any stores. If you need to buy things, for the most part, people are using Amazon more than ever as just a perfect example. And that's why, you're seeing Amazon go on this incredible run. So all of big tech has performed phenomenally well. And part of it is at the cost of, these smaller companies that are out there. So I've been saying this all the time to my team. It's almost like, depending on which index you look at right now, it's like you're looking at different universes. And I've never seen that at any point in my career. Usually, maybe there's a little relative strength in the NASDAQ maybe, and a little relative weakness in the Russell 2000 comparatively. But I've never seen such a big deviation where this NASDAQ is just trending higher, moving higher like an absolute champion, and this IWM just can't catch a bid, and the SPYs are kind of somewhere in between, right? The SPYs are not making all-time highs, but they're pretty close, and they're at the upper band of this range where we can look for reference here. We can see the whole coronavirus crash, right? So look at the NASDAQ here, coronavirus crash, and look where it is now, and then look at the IWM. Coronavirus crash versus where it's now. So I've never seen that big of a deviation before, and I have never at any point in my career seen relative strength and relative weakness be so important. Relative strength and relative weakness, so like the way that I look at trading, that is one of the layers of probability that I'm looking at. So real simply, Trading is about risk, reward, and probability of success, right? That's the magic formula of trading. Risk, reward is simple math. Probability is much more dynamic. It's much more difficult to understand because there's many things that are affecting an individual stock or affecting the marketplace at any given point in time. Those things I call layers of probability. So for example, one of the most important layers of probability is the market itself. Simply put, if you are buying a stock and the market's going higher, you're going to have a higher probability of success than if you're buying a stock and the market's going lower. And that's just because there's a large correlation between individual equities and the market as a whole. And then I have all of these other layers of probability that I teach my team to learn to look at for any trade that they're getting involved in. And one of those is relative strength and relative weakness. And what I've been preaching for months now is you want to be long relatively strong names. You want to be long up until maybe yesterday, Tesla and Amazon and Apple and Nvidia and Microsoft, Alibaba. These are where your relative strength is. That's where you want to be long. What do you want to be short? Well, you want to be short things that are getting hurt by this economy, right? Airlines, cruises, maybe banks, right? And you can just see based on the 200 simple moving average here, even there you can just see like the weak names are all below their 200. The strong names are all above their 200. And I don't remember the exact statistic, but one of my team members told me a statistic I think last week about it's something like 80% of NASDAQ names are above their 200 simple moving average, whereas only 20% of S&P 500 names are, or maybe it was Russell, I forget, are above their 200. So you can see it right there. And it's interesting. I know traders right now are making money by being long the market in tech. But I also know that there's traders out there making money right now by being short the relative weakness. I personally have been more primarily focused, even though I caught this initial move in some of those big tech names really well, I've really been more focused on the short side of things in weakness. So I got really scared yesterday. So again, probably my biggest position right now is in this TZA, which is basically betting on the IWM going down. It's betting on that continued relative weakness. It's betting on, unfortunately, the economy not really being able to recover for small companies the way that we want it to. And I've been doing very well with it overall, but I got really worried yesterday morning. Why? So the way that I like to trade is, I come up with ideas, and then the technicals tell me how to trade those ideas, how to manage risk. The technicals tell me when I'm right and when I'm wrong. Well, the S&P 500 yesterday morning was really telling you that if you have shorts on, you're wrong. That's what it was telling you in the morning yesterday. So again, let's go to a 5-minute chart. This is Friday. This is yesterday. And this is today so far. So yesterday we had this potential breakaway gap, very large gap, right? So Friday we closed, approximately 217.50. Yesterday we opened up above about 317.50. Yesterday we opened up above 320. Potential breakaway gap. Again, a breakaway gap is where you're gapping above resistance, and it tends to lead to a gap and go scenario, which means that you trend in the direction of the gap. At the same time, I cautioned my traders to be very aggressive, not to be very aggressive to the long side right off the open. Why? Because this gap is creating a lot of initial upside extension. How do I measure extension? Personally, with my own trading, I measure market extension based on where the price action is versus the space between the 8 and 21 EMA. So if the market's trading above 320, but my 8 EMA, which is the green line here, is down at 318, I could say that the SPYs are extended to the upside away from their upper band of equilibrium by $2. Well, markets that are extended, they can just go if there's strong momentum, but it's much more likely that they're going to rest, that they're going to correct. And that's exactly what happened here. This was actually, even though we pulled in slightly, this is a very bullish correction because we mostly corrected through time, right? We basically went sideways. We pulled in a little bit. We basically went sideways. That we let the 80 EMA catch up to price. We put in this little, doji right here at about, just after 10 a.m. And once we broke that opening high, So really on this bar here at 10.10. I said to myself, well, I guess I fought the good fight on my short, right, in that TZA, and I've been trading that TZA very actively on a day-to-day basis. And again, I gotta say, I don't always trade everything really well, but that TZA I've traded really well. And I was like, all right, well, you know, the S&P, obviously the IWM has been relatively weak, but the S&P is breaking out. It's breaking out of its range. And I told myself that if the S&P really gets above 318 quarter and holds above, that's when I really am starting to know that I'm wrong on the idea. And it's okay to be wrong. You know, I'm wrong all the time on my own trading. And the best part is when you're wrong and you still make money. That's what I love more than anything else. How can you be wrong and still make money? By having good game planning, which is an entirely different trading skill that I'm not going to get into today. So, you know, we broke that opening high. We're having the gap and go, textbook. And then all of a sudden in the afternoon, something weird started to happen. And it honestly started with the NASDAQ, with the most relatively strong of the indices, right? Again, that daily picture of this NASDAQ, just this beautiful, beautiful uptrend. So we started to see a potential hole, and some of my traders did a great job actually shorting in the middle of the day in this consolidation, shorting tech names, shorting Apple, shorting Tesla, right for the breakdown. You know, Apple had that crazy run yesterday morning on incredible strength, and then this consolidation here, which, you know, technically this would normally be a bullish consolidation. It broke down, right? Tesla, which has just been in outer space, same thing, right in here. Formed this little triangle. That triangle broke down. So we actually started to see Qs break down first, right? So Qs here really start breaking down at about 1240. But interestingly enough, that weak indice, what's it doing at 1240? It's breaking out. So that's mean reversion, right? Well, one of the things I've been really impressed about, going back to the bigger picture, again, I'm talking about this concept of relative strength and relative weakness. Relative strength and relative weakness can be a little bit difficult because it's within the confines of, you know, there's this thing called mean reversion in the market. And there are traders out there, there's traders that I know, who are just, you know, stat arb pairs traders. And basically they measure historical correlations between different indices, different equities, and when those correlations move away from each other, one starts to outperform and one starts to underperform, they'll short the outperformer and they'll purchase the underperformer looking for mean reversion, right? So that is something that exists in the market as well. So all of a sudden, though, again, here at 1245 or so, the IWM, so again, this is yesterday's price action here, is breaking out to new intraday highs and starts really going just as the Qs start to break down. And now for my short, which is really more IWM focused, I was very worried about it because the spies are telling me the market's going higher. I still hadn't gotten out of any of this really. If anything, I was actually still getting heavier because it hadn't broken above its resistance yet, which is closer to this area between 145 and 146. So then even some of my traders on my team were actually trying to purchase the IWM and short some of the NASDAQ names, which is the complete opposite of what you wanted to do for months now. But it made sense in that moment because of the relative strength on the smaller time frame because of potential mean reversion in the IWM than we saw in the NASDAQ. But what I was telling people on the team is, look, if this NASDAQ starts really selling off, you might have some mean reversion, but there's no way the IWM is going to not sell off with it. Maybe it doesn't sell off as hard, and that's where your mean reversion comes in. And the thing that I was most worried about for any type of mean reversion idea is that the NASDAQ would start going sideways, and that the IWM would start catching up to it and have your mean reversion take place that way, which would, you know, hurt me because, again, I'm basically short the IWM via the TZA, by being long the TZA. So, you know, that's all the stuff that we were looking at yesterday. And then, you know, that NASDAQ rolled over first. SPYs rolled over second, right? So SPYs really didn't top out till 135. And this, by the way, is not a great topping candle. And I talked about in yesterday's afternoon meeting, like, catching the high in the SPYs for a short trade yesterday or recognizing, I should say, even better, recognizing that this breakaway gap was going to fail based on this high at 130 is almost impossible. There's no extension here. There's no upside volume here. There's nothing really to sink your teeth on that lets you know, okay, this is the time where I should be starting to hammer SPYs, outside of recognizing that the Qs were breaking down first. And then last was, this IWM really started to roll over. And then we closed very weak on the day. Go back to the daily candle here in the SPYs. We closed really weak on the day. So yesterday was a breakout failure. So that's important, right? What does it mean for going forward? Well, we closed on lows. We had a breakout failure. Usually that means that whatever that low is not going to be the absolute low. But the thing with the SPYs here is that we don't really have too much extension to the upside. The NASDAQ does. Like the NASDAQ up here at 270, again, how do I measure extension? It's where the market's trading versus where the 8 and 21 EMA is. NASDAQ here up at 270 was very extended. And we know some of these tech stocks have gone completely parabolic. Amazon has gone parabolic. Tesla's gone parabolic. Apple was starting to, not as much. Even Microsoft was starting to go parabolic. eBay basically going parabolic. I've never seen eBay go, Microsoft and eBay, one of the things you want to learn to do as a trader is identify like what we call the personality of the stock. Stocks have different personalities, almost like people. Some stocks are thick, right? They have a lot of liquidity. That's a word that we use to describe liquidity. Some stocks are thin. Some stocks are momentum stocks. Some stocks are more grindy trend type stocks. eBay has never been a momentum stock, but a stock going parabolic, that's a sign of momentum. At least not in my trading career. eBay's never been a momentum stock. Maybe back in, I don't know, the tech bubble in the year 2000, if eBay was even around then. I'm not even 100% sure. It's a little bit before my time. It might have done it. But in recent history, this thing has never been a momentum stock, and it's starting to go completely parabolic. And we notice these things because, honestly, it's not healthy. It's not healthy. And look, if anyone caught this Tesla up move and made 80% in 5 days or whatever it is, 10 days, congratulations. It's a phenomenal trade. And if you understand momentum and you understand how breakouts work, you definitely could have caught it. But at the same time, you got to start to recognize that it's not healthy when stocks and markets are doing this. This is just not how a healthy market trades. It's not healthy that you can have certain tech stocks starting to go completely parabolic, whereas you have, General Electric can't catch a bid, right? The regular, quote-unquote, regular companies out there can't seem to catch a bid and are basically at lows and are extremely weak. So, these are all the things that we're noticing. And when I'm trading, even from day trading, I'm always starting everything from the big picture. Everything I do, my morning research, I'm reading all the news, but I'm assessing the gap. I'm assessing, is the gap putting me in a position where I can, where I should push it today? There's a lot of opportunity out there because of how we're opening. I should be aggressive. Or are we opening up somewhere where, it's a little bit more difficult because I don't have as much of an advantage. We're opening up in a tricky area. Today was honestly that way. So coming into today, just trying to figure out a game plan, when I first logged into my software, we were set to gap up. Let's take a look at the pre-market price action. So now this is yesterday afternoon. So basically we closed right here yesterday. So we closed about 314.80, and when I was really kind of logging into my computer around 6 to 8 a.m. We were up near 316 or so. So we were set to gap up about $1.50, $2, something in that range. That excited me. Why? Again, everything starts with the big picture. Why, based on how we closed yesterday, would I want a gap up today? Because I know that this candle yesterday, this failed breakout, puts the market in what I call guilty territory, right? So the market needs to prove its innocence to me now, because this candle is no good from yesterday. This candle should not have closed this way. Yesterday was a failed breakout. So if I can gap up today, the higher the gap up, the better, as long as it's beneath yesterday's high. That excites me to come in and short things. And I actually was able to do that a little bit pre-market. I actually added to my TZA position, I think around 8 a.m. or so, which just happened to be, not that I timed it perfectly. It just happened to be kind of that pre-market high. But it's only so heavy you can get pre-market. And then we really sold off here. The CPI number came out at 8:30. That kind of added to the sell-off. And then by the time we opened with a gap down. So that actually does the opposite. And this is back to today, right? So this is where we closed yesterday, up here around 314 and change. And now this morning we're opening up down at 313.30. Well, that's much more difficult than the gap up from the perspective of understanding my advantage in the market. Why? Because, we're gapping down right into this difficult area. So now from the bigger picture, bulls need to recapture yesterday's high to get this market to be healthy again. And bears need to not allow that to happen. On the downside, the bulls really need to defend last week's low, 310.68. I would actually call it the area between 310.68 and kind of where the 21 EMA is on the daily, which is 311.50. Today's low is 312. So that's the area that bulls need to defend. And yesterday's high is the area where bears need to defend. So that's the whole thing about a range-bound price action. Who's really in control right now is very hard to say. I would kind of say, even though, definitely before yesterday's candle, I would say, all right, bulls are starting to take control. They're starting to set us up for a breakout. But now that breakout failure, but what does it actually mean, that breakout failure? How much of a pull-in should we have? Well, technically there's no extension here in the SPYs, and that's one of the things I want to measure, right, is extension. So, again, on the downside, I really can't expect to move more to too much past 311 on the downside. I mean, today's low is 312. We almost got there. If that breaks, though, then we could very quickly be back down at these previous lows. The NASDAQ was very extended up here, but look at how the NASDAQ has been trending ever since its low in March, right? So here's the low in March, down here. And we've just been in this beautiful upward channel of higher highs and higher lows in the NASDAQ, right? Just based on those pivot points. Every time we've gotten a little bit too extended, we've price correct back down, right? And again, this extension is versus the space between the 8 and 21 EMA. So the market pulls back somewhere into that area, pivots, and gives continuation. So depending on how we close, like if we close right now with the Qs back up here, this would be a pretty bullish close. So now we would have very competing factors going on technically in the market if we close strong today. We would have yesterday's failure candle followed by today potentially making a tail, which is potentially trend continuation. It's the same thing. Bulls now will need to defend today's low. Bears need to defend yesterday's high. Who's going to win? I don't know. Usually, the direction of the trend wins, right? So we're already uptrending. Most likely, we just got extended here. We pulled back. Bulls will regain control and will break highs. But the thing to really pay attention to about that is that we don't have continuity amongst all these different indices, which is really important. So again, your IWM is a completely different picture. SPYs are a little bit of a different picture also. So just again, those are the things I need to think about. And everything that I'm describing right now, I'm approaching each day's trading session with this background understanding of how the market is set up. Because understanding how the market is set up, understanding institutional positioning, those are the keys to understanding the big picture movements for the market. And even if you're only a day trader trading on the small picture, you have to be having an eye towards the big picture with what you're doing in order to have probabilities be on your side. And then we can break down from there all the way down to all the different equities that the team is potentially looking at, and what has relative strength, what has relative weakness, etc. One of the longs I got into today, I got into some Twitter today. Twitter had this news here on July 8th, just a few trading sessions ago, that they're potentially going to a subscription model. Obviously, and then it's set up really nicely here, this 2-day inside bar, we call it a daily shooter. The problem with that shooter is that the ADMA hadn't caught up to the base yet. and it tried to go yesterday, but the market just rammed it back down. So, today, off the open, I'm basically looking long, more or less versus that low from a couple of days ago, and it's letting me get in on a good potential setup in a stock that might trade a little bit independently of the market. But I still need to understand where the market is. So, I bought this cautiously today because I'm still really worried now for longs based on yesterday's candle. So that's kind of where we're at now on the charts. So with that said, let's go back to our slideshow. And I'm happy to answer questions, by the way. Guys can post questions in the YouTube chat area. I'm able to see those as they pop up. So questions about prop trading, questions about the market. I'm happy to talk about all of that. So as I've just spoken about the market, let's just talk real quick about being a professional trader with T3 Trading Group and what that actually means. So we are currently bringing in traders into our professional prop group. T3 Trading Group is one of the largest proprietary trading firms in the United States. We have over 500 licensed professional accounts. We have our headquarter offices in Manhattan. I mentioned I personally run the trading floor at our Manhattan office. We have other offices, Atlanta, Georgia, Boca Raton, Florida. There's a couple in New Jersey. Right now, they are all closed because of COVID. Not 100% sure when they're going to get open either. But again, most of our traders were remote traders to begin with, and things have been so smooth on a remote basis. The VTF is better than it's ever been before. Everybody's communicating in the VTF room. We're getting our ideas in there. Guys are putting the news in there. Guys are putting the large option order flow in there. So things have been really smooth on a remote basis. So we're bringing in remote traders as well. We are a registered SEC broker-dealer and member of FINRA SIPC. So that means that if you want to trade professionally with us, you got to be licensed. There's 2 exams that you have to pass. The first is the SIE exam, Security Industry Essentials, and the second is the Series 57, which is the Professional Proprietary Traders Examination. We'll provide you with study materials. We will sponsor you for the exams. So, we can help out with all that. You do have to pass a background check in order to become a professional trader, which includes, making sure that you're not, a criminal, a felon or anything like that. It also, includes a credit check as well. And licensing is key, right? It should almost be a red flag if you hear, for me it would be a red flag. If you were speaking to a proprietary trading company and they said you don't have to be licensed, who's regulating them? Once those tests are passed, we have 4 different software options for our pro traders: Lightspeed, Fusion, Sterling Trader Pro, and WEX. We have equities trading, futures trading, and options trading. We're primarily an equities trading focused firm, but we do have those other asset classes as well that you can get involved in. One of the best parts about T3, I started managing traders in 2013. That's when I started my own trading desk. And it was really just me and a couple people. And I've built that out into a really solid group. I'm probably managing 70 to 80 people on a day-to-day basis, something like that. The main way that I was able to build that group up is by creating a lot of infrastructure for the training and development of the traders that I work with. So, morning meeting every day at 9 a.m. Eastern, afternoon meeting every day at 10 after 4 p.m., optional 1-month training program when you first get started. All my traders get free access to my VTF room, to Scott Redler's VTF room, to Redler All Access. So that training and development is really important. And I've got traders of all experience levels. I've got guys who started with me who were, brand new entry level out of college who we've developed into strong traders. And I've got other guys who have, sometimes decades of professional trading experience. Former floor traders, maybe former pit traders. And regardless of experience level, I've gotten really good feedback from the training programs that we provide. I don't need to teach an experienced trader, bids and offers and what a Japanese candlestick looks like. But even the experienced people will get a lot out of like a tape reading class or a class on routing, because that's an area that I personally think I have a lot of knowledge on, and honestly a lot of people don't. And learning professional routing with direct market access. You don't have direct market access if you're trading through Robinhood or TD or E-Trade. They're selling all your orders out to HFT firms. So understanding the implications of direct market access, how you can utilize that to increase your speed in trading, increase your cost efficiency, is important. So I go through all that. You are required to commit a capital contribution. It's a first loss model, so any initial losses that a trader takes while they're trading with us would deplete from their capital contribution before it could potentially eat into any T3 money. And what we do on our end is we typically start by providing buying power at 20 times the capital contribution for intraday trading and 8 times for overnights, at a 90% split to the trader, somewhere in that range, 90% or so. It depends a little bit on the deal structure. If you came into the firm and you deposited $50,000 with us, we could allocate you $1 million to start your trading without a problem. And there's plenty of people who come in even larger than that. There's no desk fees. I mean, you do have to pay for professional trading data as a professional trader. So I think, access to the New York Stock Exchange, NASDAQ, and Amex is like $200 a month. But that gives you, depth of market, gives you direct market access. There's a lot of advantages that come with that as well. Again, I already talked about all the training and mentorship that we would provide to our incumbent traders. And again, experienced traders are very welcome as well, all levels. We can work with the brand new person who's directly out of school, and we can work with you if you've got a couple decades of experience to help take your trading to the next level. And again, in addition to my training program, you'll get ProDesk VTF trading room, which is the room that I run, where the morning meeting and afternoon meeting are taking place there each day. The morning meeting is more about idea and information and research sharing amongst the group. The afternoon meeting is a review, but what I'm trying to do in that review very specifically is draw lessons out from the market, from individual names that I know large percentage of the traders on the desk are involved in, so that we can learn on a day-to-day basis from real-time, real-world examples. You also get access to Scott Ruther's VTF room, the Trader Hub. The Red Dog is a guy that I've learned a lot from over the years, real industry veteran at this point, super sharp trader. So you get access to that. You get his Red the Roll access as well. So that's all the stuff that you get as a prop trader. The number one goal is to make our traders as successful as possible. With that said, every trader is making their own choices and their own decisions. You decide how much risk you want to be putting on an individual trade, how you want to game plan the reward, what to be involved in. And then we're going to do everything we can to support you to make you as successful as possible. So if that interests you, reach out. There's my email address right there. My name is Derrick Oldensmith. It's been a pleasure speaking to you guys for today's webinar. Let's see, does anyone have any questions? Sure. So the training program basically consists of a series of lectures, and it does start pretty basic. Basics of technical analysis. What I believe technical analysis truly is: learning to trade and execute support and resistance trades, breakouts, breakdowns, etc. And then gets more advanced into game planning, trailing, my personal rules for how I trail stocks that are with the trend. We get into risk management. We get into market psychology. We get more in depth into technical analysis and chart patterns, tape reading, routing, market psychology, how to journal. So basically, it's a training program. Basically, consists of a different lecture each day. Direct market access, right? So as a professional trader, you choose how you want to route your own orders, right? So if I were to bring up my level 2 box here, just going to a stock that I have no position in, AIG is an example, I can see the depth of market. So I can see, the 30 inside bids and 30 inside offers for the exchanges that I have data access to, basically the ones that I pay for. And that is advantageous, but I'm also able to choose how I route that order. So if I was going to put a bid in for 100 shares, right, here is a 100 share bid, I choose my price, and I choose how I want to route, I could, if I pressed enter right now, it would put a bid in at 30.22 and it would route to ARCA. Or I could route to BATS, EDGE, New York Stock Exchange, NASDAQ, EDGE. And routing to different venues on the light market, there's different benefits to it, right? And it's a little complicated just to talk about in today's webinar. But basically, most of the ECNs and exchanges will pay you for your order flow. So if I were to put this bid in at 30.22 on ARCA, and that bid got hit, ARCA would pay me about 0.2 of a penny for providing that liquidity to their venue. The opposite is true if you take liquidity, right? If I were to use a market buy button right now, depending on how I route, I would be paying for the pleasure of taking liquidity, right? So if I took liquidity on ARCA, I would pay something like 3.2 of a penny or something like that, 3.5 of a penny. So it's more expensive to take liquidity than it is what you get rebated for providing liquidity. And that's how the ECNs and exchanges basically make money. But it gets into a lot more depth than that, because there's different ways that you can route where maybe you can get your order filled a little bit faster, or there's different ways where you can route where maybe your order is not the first to get filled, but you get paid a higher rebate than you would otherwise. So if you're a very active trader, like I tend to be, it's not unusual that I'll trade 100,000 shares in a day. If you tend to be a more active trader, knowing how to properly route can really save you on costs. Where again, if you are routing through, you're trading through E-Trade, as an example, you don't get any of that benefit. If anything, it's the opposite, right? You think you're having these quote-unquote, free commissions, but they're front-running. They're keeping your rebates on limit orders. They're front-running your orders. You do not own the order. They sell those orders out, and it's all public information. You can look at the SEC 606 rule for whichever broker you're looking at. But on average, based on what I've seen, the brokers get paid about 0.2 of a penny for your order flow. So obviously, if the HFT firm is paying 0.2 of a penny for your order flow, it's because they're able to make more than 0.2 of a penny off of your order flow. How much exactly? We can't know. I'm sure there's variance to it. My guesstimate is that it's really costing you about $10 per thousand on your trading, whereas you don't have to deal with that with direct market access. But it's also a little bit more complicated. Some people don't care. They don't care if it costs them money internally. It's simple. It's easy. It's what they're used to, and that's fine. But other folks, especially if you're a more active trader, you really want to be able to have that depth of the market and direct market access. Okay, guys, well, if there's no other questions, I'm going to wrap things up for today. I'm going to get back to my trading. So, good webinar. Always a pleasure to speak to everybody. And, good luck out there trading.